the Trump Media and Technology Group, parent company of Donald Trump's Truth Social, which trades under the ticker DJT. I just simply want to talk about the stock itself, which is currently valued at around 3 billion quid, despite the fact that it makes pretty much no money. It took in less than £1 million in revenue last quarter while losing about 17 million. But why we're talking about it today, September 19th, is the day the lockup period ends. And so a lockup period is basically a span of time where insiders of a company are not allowed to sell their shares after going public. It's usually about 6 months. The co-founders of the company, Andy Latinsky and Wes Moss, they're all expected to sell as they no longer work there. They've been involved with lawsuits, which I think anyone who goes into business with Donald Trump ends up being sued in some form. So there's kind of bad blood there. They're not happy with how many shares they've received. They're all expected to sell straight away and just be done with it and get their payout or whatever. The big question is whether the Donald himself will sell. Hi there, and welcome to Stock Club, a podcast brought to you by MyWallSt. I'm Mike, and joining me today is MyWallSt analyst Anne-Marie Kingsland. Before we get into today's show, I just want to make sure you know about Nexus. Nexus is our international hidden gem stock picking service. So I can promise you there's 15 stocks in there. I'd be very impressed if you've heard of one of them. But it's a market-beating service, and we have a very special offer. It's extended from last week. All you need to do to hear about the offer is email in at pod@mywallstreet.com. That's pod@mywallstreet.com. Okay, and we'll get into the show. Anne-Marie, how are we doing?
I am well. How are you?
I'm good. Are you liking my new background?
I am, yeah. Is that now? Did you select that on the Zoom call, or is that actually on the wall behind you?
It's actually on the wall behind me. I wish I selected it. Can I just have half of Sphinx, please?
Is that a Sphinx or is that a Buddha?
Oh. This isn't good for podcasting where I'm just staring behind my wall in silence.
We're both like, what is that?
Okay, maybe. I'm not sure, but I'm sure it is in some
culturally
way.
ambiguous statue.
Exactly. Okay, where are we going? Oh, we have to kick off just a little follow-up, a victory party for you. Red Lobster is successfully out of bankruptcy. They've stopped.
It's back, baby.
Stopped giving away free shrimp, and suddenly the finances make sense again.
I know, yeah. They got a new CEO. His name is Damola Adamalekin. He just, yesterday, he got a big profile in Business Insider.
Yeah, he's kind of been going viral, hasn't he?
Yeah, he's 35 years old. He's really young to be CEO, and this is his second CEO-ship. He worked at P.F. Chang's for 5 years before this. So he first served as CEO when he was 30, and he successfully turned P.F. Chang's around. So it makes sense. He's from the restaurant game. He's done this before. He knows how to work with an established brand. It's a great pick. And he basically got a private equity firm together and said, we're going to inject $60 million into Red Lobster and we're going to save the cheddar baked biscuits. So here we go.
A noble effort from him. Fair play. Yeah, no, I saw he popped up on my social media. He was talking about his daily routine or something. I was like, this is very... Oh, yeah. This seems a bit like an industry plant. Does that make sense?
Yeah, because he gets up at 4:00 in the morning and goes for a run for 2 hours. He is one of those. Yeah.
But anyways, okay, where do you want to go to first? We're kind of covering a lot of bases for this episode.
We are. I think we're going to run through 5 key stories from the week because it's been a very busy news week, but we haven't had any
big ones,
show-stopping, big headline kind of a thing. So I would say, would you like to kick off with Uber maybe and their deal with Waymo?
Yeah, so this is going to be a very quick one. We had a big episode on autonomous driving a couple of months back. Me and Emma were chatting about it. So this is kind of an extension of that, I suppose, in a sense. So basically, Uber and Waymo have extended their partnership. So I wasn't aware. They actually already had an existing partnership where you could hail a Waymo one in Phoenix. So if you're thinking about maybe say as in the Phoenix was a test market for Waymo to see if there was demand from the Uber app. And I guess it passed. So they just announced last week they're extending their partnership. So now you can order a Waymo in Atlanta and Austin from the start of 2025, I think, which is, it's pretty cool. And we're seeing this happening obviously at a very low level. Like there's only
Mm-hmm.
3 cities now, and from those 3 cities, not every Uber is going to be a self-driving Waymo, but it is slowly becoming available, and it's very,
Yeah.
very exciting. Like this is, self-driving cars is one of those futuristic things we've always talked about, and it's like, is it going to play out? How is it going to play out? Well, we're starting to see it firsthand. So yeah, there's a lot to unpack with this. I mean, first off, we're going to talk about Uber itself, because
Mm-hmm.
we saw with Uber, like long term, autonomous driving really was a threat, and now we're seeing it. Maybe is that the case? Is it going to be a facilitator or even a beneficiary of autonomous driving?
Yeah.
Um, because they've already had a deal in with GM's Cruise. You're going to be able to hail one of its self-driving vehicles from the app soon. Now Waymo already has its app. Waymo's got an app called Waymo One that was operating in Phoenix, or no, sorry, not Phoenix, Austin, on a very limited basis. But they said they're going to be transferring the service to Uber next year. So what does that mean? Is this them kind of giving distribution rights to Uber in a way? Because if so,
Mm-hmm.
like that's absolutely huge. It could legitimately be just
Yeah.
be turning one of Uber's biggest threats to an asset where it becomes this, I suppose, facilitator or distributor of autonomous driving in a way. And like,
Yeah.
if you're Waymo, if you're Cruise, are you just removing a huge headache by not
Mm-hmm.
being the kind of distributor? Just basically, it's almost like licensing your product out. So yeah, I think it's very interesting. It's a story that could play out over the next decade, not the next year or two. But if Uber could be that chief distributor of robo taxis
Yeah.
and not lose its top spot in ride hailing, even like extend its top spot in ride hailing, you're looking at a potential mega business. Now, the only
Yeah.
thing about that is that it's lost a lot of control then, because Waymo or Cruise or whoever else are going to be kind of not a puppeteer per se, but it's lost a lot of its kind of negotiating power, we'll say. What happens if
Yeah.
Waymo sees the kind of demand it wants to see and then says, all right, we're going to run up Waymo One now because it's got all the resources of Google behind it. So yeah, it's an interesting one. I think it's going to be a very long term kind of saga of what we see happening, because it seems like Uber isn't backing the technology at all itself. It just wants to be this middleman.
Mm-hmm.
Middlemen aren't always great businesses. So
Mm-hmm.
yeah, there's a lot happening here. And then I think next month, October 10th, Tesla is having its robo taxi launch event as well. So they're going to kind of inject themselves into the conversation too. So yeah, there's a lot going on with autonomous. Very
Yeah.
interesting to see Uber and Waymo teaming up. Very interesting to see Waymo kind of ready to go, if that makes sense.
Yeah.
Um,
Yeah. Because everyone always thinks of Tesla, like when they think of the autonomous driving, there was always an assumption that Tesla was there first because they kept putting partially complete products on the road. So you were always thinking, oh, yeah, like Elon and them have achieved functionality before anybody else. But those Waymos have been, particularly in San Francisco, they've been functional for a long time and they've been cruising around and honking at each other in parking lots. But I think what will be particularly interesting is it's probably a great way to expose the public to the technology before it becomes available for you to maybe own in your own home, particularly for GM. Like if GM has a functional vehicle, to be able to essentially encourage somebody to participate in that technology for, a 15-minute Uber ride, a 20-minute Uber ride, and get used to how good it is. It probably is then a great way to do brand exposure, essentially. But I do have a question, which you might not have the answer to because oftentimes these deals are private. But do you know, are they doing a revenue split, or has Uber paid a flat fee, or is it just because they're sharing tech? Do you know what that looks like?
I haven't seen the full details. It wasn't published, anyways. You would assume revenue split makes sense, but
Yeah.
think in terms of these are trial periods, pretty much.
Hmm.
Those logistics don't matter too much. It's just kind of showing demand and I guess
Yeah.
seeing if this is possible. And when it comes
Hmm.
down to the nitty gritty, we'll see something like that. But is Waymo just using Uber for right now? And
Yeah.
then it comes and does Waymo One, and Uber is irrelevant. I'm not sure. So yeah.
Yeah, I wonder if it's a thing of like they get the experimental data and then Waymo comes out with his own product and can undercut Uber on price because the personnel cost is so much lower.
Completely, and it doesn't have any of
Yeah.
the headaches Uber has. But but yeah, we'll see. We'll see. It's interesting,
Yeah.
and it's still a long way to go. But I always find any developments like this are very interesting because I'm repeating myself now, but it's like it's really happening. Do you know what I mean?
Yeah.
We're actually
Yeah.
having self driving cars fully commercialized in small pockets, and I don't think it's a coincidence that maybe Texas and Arizona and Georgia would be probably more business friendly
hmm
areas to set up, less regulation or whatever. But yeah, so that's Uber and Waymo. What do you got up?
We're gonna head over to Amazon again. It's a brief story, not too much to it, but essentially, Amazon CEO Andy Jassy has ordered every corporate employee to come back to the office 5 days a week, with the exception being unless you get an exemption from the organization's S team leadership, which is a close knit of executives that report directly to Amazon's CEO. So basically, unless you're on the board of Amazon, you're going to the office 5 days a week. Like,
rules,
there's no way around it.
rules for thee and not for me. Yeah.
Yeah. Andy gave a nice quote on this. He said, "Before the pandemic, it was not a given that folks could work remotely 2 days a week. And that will also be true moving forward. Our expectation is that people will be in the office outside of extenuating circumstances." In his message on Monday, he also said that he was worried that Amazon, which has long prided itself on preserving the intensity of a startup while growing to become a tech giant, was seeing its corporate culture diluted by flexible work and too many bureaucratic layers. The other element to this is within the same announcement, he said that they're going to be removing a lot of middle management in the attempt to make the company flatter, which that decision I actually agree with because there
Big
has been
time.
an
Yeah.
argument in big tech for the last couple of years that a lot of these companies have become quite bloated with managers rather than talent. And so I think that will be interesting to watch Amazon over the next couple quarters to a year to see how that goes, because I think that's a worthwhile move. But the 5 days a week in the office thing, I don't know if I agree with, particularly when we know the vast majority of the work that these people are doing is computer based.
Mm.
Like, I don't,
Do you think it's a kind of subtle way, or even a cheap subtle way, to do layoffs in a sense? They know a lot of people are going to leave because of
yeah,
this.
yeah, it could be definitely because particularly young people who entered the workforce in 2020, it's now a fundamental expectation that they will have the right to work from home. And so I'd say if you are an engineer in the first 5 to 6 years of your life, you know that there tends to be a competitive job market out there. You know, there's a lot of tech available to you, particularly if you're in like one of these central hubs, Seattle, San Francisco, New York. I would say, yeah, you'd say, I don't want to go to the office 5 days a week. I'm going to quit. I'm going to find a new job. So I would say you're right. It probably is a way to cut costs without having to pay out massive severance packages, which we're seeing in big tech already. You know, Google's laid off a number of people recently. Um, Anecdotally, though, I also heard reports via social media, and some newspapers are picking it up. There was apparently a trend within Amazon already because they had been at a 3 day a week policy. But the way that they tracked that was through the ID card scanning in and out of the offices. And apparently, a lot of employees were coming in the morning, eating breakfast, and then going home, which you got to respect it. They
That's
came in.
that is literally having your cake and eating it too. Like,
Yeah. And so apparently by mandating 5 days a week, they thought that additionally it would put an end to this behavior of the employees just coming in, scanning in, turn around, going back out in order to get the tick mark of being in the office for a day for HR. So, yeah, but also it's importantly to state that this is maybe not a trend that we're seeing across the board. You know, Amazon is a big name and they obviously have a lot of employees, tens of thousands of employees. But according to Professor Bloom, who is over at Stanford University, he actually doesn't think that this announcement is a sign of a wider shift within work policies or even within the tech industry, noting that his data has found that time spent at the office has been fairly stable for more than a year. So for every high profile company canceling work from home, there's others that seem to be expanding it. They just don't seem to get picked up by the media. So if that is true and work from home is continuing to be the overarching trend, particularly within this industry, I think what you said is correct. Amazon is probably trying to push out workers who want flexibility, and they will go find alternative opportunities, and everybody else will keep trudging along in the Amazon HQ. Also, the pessimist in me, which I think this is the argument that people talk about a lot when it comes to big tech companies ordering the staff to come back in, is preservation of real estate value, because
mm,
Google is like the largest holder of commercial real estate in the United States, for example.
I think
And if
Facebook is in
those
Dublin as well, isn't it?
Yeah, and so if you as the owner of the real estate, have said, oh, but offices aren't really worthwhile anymore. You're essentially devaluing one of your central assets. And so I do think that sometimes these big tech companies, there's definitely an accountant involved in this decision making saying, listen, the value of $100 million of real estate is depreciating every year that we do not have staff working here. So maybe you should order your staff back just to preserve our balance sheets, essentially. And I think about that all the time because you know how Facebook built that new office in Balls Bridge. I don't know if you've seen it. It's massive. It's all glass.
Yeah, yeah,
It's a
yeah,
beautiful office. It's empty. There aren't even desks in it. There
yeah.
are no desks. There are no chairs. It's just an empty, voided space, which always has all the lights on. I don't know why. So you go by there at 9 o'clock at night. It's a giant glowing cube of emptiness. There's no employees in there. So it's not a great look if you've poured tens of millions of dollars into this building and into owning this land, and then you just don't have any staff in there. So that's the pessimistic side of me. I think it's a real estate play, but anyway.
Yeah, it's interesting. I always think it's a bit of a straw man. Like
Mm,
top management are blaming remote working when it's never really the case. The people who are going to take the piss out of it would also be doing a kind of lackluster job, even if they're in the office,
yeah,
if that makes sense. But it's just something to blame. It's like I've compared it to politicians blaming the housing crisis on Airbnb because it's
yeah,
a very tangible thing you can point at and be like, this is the reason, not a bunch of small reasons that I have more control over. So yeah,
yeah.
maybe it's Andy Jassy, like, because he's doing pretty well since he came in as CEO. Like Amazon stock
Mhm.
is done. I don't think like there's any questions of underperformance from him, but maybe it just looks like a strong man move of some kind to kind of establish himself
Yeah.
and away from the Bezos sized shadow of things. So yeah.
Yeah, that would be fairly difficult to be living in Jeff's shadow as he lives it up on his giant mega yacht that he tried to shove up that river in Amsterdam, and it didn't fit under the bridge.
Yeah, his
You know,
shadows
we
also
every
just got a lot bigger recently when he got jacked up on steroids as well.
yeah. Ooh.
um, okay, what's next? Are we going to DJT, the Donald?
Yeah,
Yeah,
go on.
they're
Yeah,
eating the
do it.
dogs. They're eating the cats. They're taking your pets away. um, okay, so first of all, this is completely apolitical. What's the opposite of an
Mm.
elevator pitch? Like an elevator warning is what I had in my head, but
An
that just
an
sounds like the lift
es
is stuck.
an escalator drop, I
An
suppose.
escalator drop. Okay, well, this is the
Yeah.
opposite of an elevator pitch. Whatever you think that is, send me in a good name for it because I haven't got one yet. But it's about the Trump Media and Technology Group, parent company of Donald Trump's Truth Social, which trades under the ticker DJT, which obviously stands for Donald John Trump. The fella never misses an opportunity to put his name on something. But
Mhm.
yeah, so this is politics aside and avoiding any controversy. I just simply want to talk about the stock itself, which is currently valued at around 3 billion quid, despite the fact that it makes pretty much no money. It took in less than a million quid in revenue last quarter while losing about 17 million. So the reason why it's worth so much, I think, is just from a completely objective point of view. Trump is the most headline making person in the world. If he becomes president
Yeah.
of the United States, the presumption is Truth Social will become a lot larger. He'll start a successful TV station, which they've already made inroads into as well in some form, etc., etc. Now
Mhm.
that is the kind of, how would I say that goes on the website, but honestly, it's just really a meme stock, and people trade because it's fun and you can base it on things that Trump does and his chances of winning the election. So, for example, they shot up uh, more than 50% the day after his first assassination attempt, when there were all the images of him with his
Mhm.
hands up and the Secret Service around him and all of
Yeah.
that. And then since Biden stepped down, the stock is down about 50%.
Yeah.
It was down 10% the day after the debate when it was seen that Trump performed poorly, and so on and so forth. So if you look at people, which is a very real thing now, there's traders out there who do it mostly for fun. Do you know what I mean? This is where meme stocks come from. If they
Yeah.
can make a bit of money out of it, great. So that's kind of the purpose of this stock at the minute. But why we're talking about it today, today, the day the podcast goes out, not the day we're recording, September 19th, is the day the lockup period ends. And so a lockup period is basically a span of time where insiders of a company are not allowed to sell their shares after going public. It's usually about 6 months. It's in place because, if I go public with michaelmahony.com and I IPO and I own 50% of the company, I can sell 20% of the company the day of the IPO, and it's just gonna shoot down, and no one involved with the IPO is gonna make any money. So that 6 month period is basically stopping the stock tanking on the first day, but also kind of regulating the sale of it, if that makes sense. Mm-hmm. Now, the concern is with the stock like this, which is a $3 billion valuation and makes $1 million a quarter or less, people just want to get out and get a quick payout. So the co-founders of the company, Andy Latinsky and Wes Moss, who actually were both on The Apprentice as well, which I found very interesting.
Good.
As well as Patrick Orlando, which is a fantastic name. Pat Orlando, excellent. Patty Orlando, whichever he goes by. So he sponsored the SPAC. They're all expected to sell as they no longer work there. They've been involved with lawsuits, which I think anyone who goes into business with Donald Trump ends up being sued in some form. So there's kind of bad blood there. They're not happy with how many shares they've received. They're all expected to sell straight away and just be done with it and get their payout or whatever. The big question is whether the Donald himself will sell. So he owns 60% of the company, which is around 2 billion quid on paper. And on paper is the operative word there, because if he starts selling, it won't be worth 2 billion quid for long. So he came out last Friday. He said, and I'm going to save you my awful Trump impression because no one needs to hear that. But he said, a lot of people think that I'll sell my shares. They're worth billions of dollars, but I don't want to sell my shares. I'm not going to sell my shares. I don't need money. And it is great for me. It's a great voice. So this sent the stock up like 25% the second after he said it, because there's such a high risk there of like, this fella owns over half of the company. If he starts to sell, it's worth nothing, because it's all based on hype as well anyways. So him saying that sent the stock shooting up. It's kind of market manipulation potentially. And basically people were enthused. Okay, well, if he holds on to the shares, this might be worth something. It's probably a bit of truth to it as well, in the sense that it's going to be very difficult for him to sell. At least he obviously can't do it in one go, but it's not like he can just push a button in his E-Trade account and the shares are gone. For a shareholder that big, there would have to be some agreement in place with the SEC, some form of purchasing plan put in place where it'll go out in increments. And once that's announced, the stock is going to tank anyway, so it won't be worth it down the line for him to sell the shares. So I don't know what's going to happen today. There's obviously going to be a lot of eyeballs on it to see if there are big sellers the day the oh my God, I'm just blanking on the word. Yeah. You literally just explained it 10 minutes ago. And I can't even remember. The day the lockup period ends, because the whole anticipation is, okay, he's just using this to get a quick buck because he might need the money. So yeah, that's basically it. It's kind of this long running meme stock. It's a fun thing to trade. You can do it based on if you think Donald Trump will win the election or not. But there's a huge caveat that if the Donald in particular, but any of the insiders start selling in a big way, the stock is headed south pretty fast. So yeah. DJT.
I wonder if he becomes president, I think he's going to have to sell it anyway, because isn't there a lot of rules about...
He would relinquish his power over it, but I don't think he would sell it.
Okay. Well, they made Jimmy Carter sell his peanut farm back in the day, so I don't see any reason why.
Well, he was supposed to do that with all his hotels and stuff, and he kind of got ignored.
Oh, of course.
But right. I assume there would be some controlling entity that would take it over, and by that stage, there would be so much hype about him winning the election, anyways.
Yeah, that would be. He wouldn't want to sell it anyway. Okay, yeah, fair enough.
So that's Trump Media and Technology Group. How did I do? Was I
Yeah.
very level?
Yeah, it was good. Except you did start by directly quoting him about eating dogs, and then you said, "This is apolitical."
I get that's like ingrained into my head since he said it. I can't stop repeating it. Okay.
Yeah. All right.
Where are we going next? Are you going to talk about the demise of Europe as we know it?
Actually, I think I'm going to start with Netflix first because the demise of Europe is very long-winded, and I suppose we will finish with the long one.
Okay.
But just briefly on Netflix, we talk about Netflix all the time. We talk about Netflix for every earnings. We never shut up about it because we're big proponents of Netflix being like the only reasonable investment in the streaming space. If you're looking to get into the streaming space, it's obviously been a huge winner for Emmett. So we check in with it all the
Yeah.
time. So none of
Also,
this is
MyWallSt wouldn't
breaking news.
exist without Netflix as well. So there's
Yeah.
that too.
Yeah. So this is not going to be any new information, but there was a really interesting profile published in the Financial Times this week all about Netflix. It was entitled How Netflix Won the Streaming Wars, and it's basically a nice chronological history from when Netflix's stock plummeted in 2021 up until now. It's grand recovery. The stock is now trading above where it was in 2021. Yay. But the element that was written in the piece that I want to focus on, which is maybe something we haven't talked about a lot, is the issue of creative capital when it comes to Netflix recently. So in the past, when we've spoken about Netflix, particularly in the way strategically it was able to disrupt the legacy studios, especially if you think about Hollywood, like most of those studios were established in the 1920s and they have continued to dominate because they have established relationships with key talent, with actors, with industry players, all that kind of stuff. And Netflix was able to come in and say, hey, if we throw a lot of money at this issue, and we focus on storytelling and we just try and find the coolest or most interesting creatives we can, we might be able to worm our way in here if we're going direct to consumer. And that did work successfully. I mean, you think about how when Netflix turned to streaming, the program that they decided to launch with was House of Cards, which is, almost like an HBO style long-winded TV show, very unlike things that were being produced at the time, other than maybe HBO and Showtime. And that really put them on the map. However, in the last year to year and a half, because we have entered a new era of the streaming age, it used to be competitive, who can get the best content out the door, who can get the coolest directors, the best actors. Now it's all about profitability. And because Netflix is the only profitable streamer, they want to enhance their profitability. So they do want to spend a little bit less. Whereas before it was throw as much money at the wall as you possibly can. Yeah, give Martin Scorsese $200 million.
Yeah.
He can do whatever he wants with it. That's insane.
But they're
Particularly for a
also
movie that's not going to a movie theater.
but they're also looking at their own data and saying, wait a minute, like I'm trying to think of what was their big budget TV. Say they published House of Cards 2 years ago instead of whatever 6 or 7 years ago, and they're like, we spent hundreds of millions on House of Cards, and it's highly rated. It's won a bunch of Emmys, yada yada yada. But more people watch reruns of Suits that we pay, X million in licensing fees for that we didn't have to produce, or Friends, or whatever else it is. And they're like, why would we bother spending so much money when we can just find the next Suits that like people just half watch while they're on their phones?
Yep, you are exactly right. And the reason that they learned this lesson, unfortunately, was because of the writers and the actors strike. So in 2023, they had initially budgeted $17 billion to be spent on content. But because of the strike, a bunch of productions were paused and they only ended up spending $13 billion on content, right? But they continued to grow their subscriber base. And that caused Netflix to go, wow, when we don't release original content as much, we continue to grow. So it doesn't really seem to be a problem. And so that has now meant that executives are more comfortable with the idea of slashing content budgets. And so it seems to be now that the way the studio is moving is more in alignment with the way that we've seen traditional studios move, particularly Disney, where they're saying, okay, we're going to get a couple of really big budget IP brand fueled ideas up the top. And then we're only going to spend a little bit of money down the bottom on the kind of the low budget stuff, the unscripted, the reality TV. Because you're correct. House of Cards can be this phenomenal political TV show that people are really interested in. But it doesn't really matter if Love is Blind can be produced for $50,000 an episode and can generate tens of millions of viewers. That's fine.
Yeah.
So that seems to be where Netflix is heading at the minute. where the budget is converging. We're going to get 2 to 3 big budget movies a year, and then we're going to get a bunch of little bits down the bottom, and then we're going to license a lot of content. So Suits and Friends and The Office and all that kind of legacy media that people are really in love with and they want to rewatch. And so that is interesting because it is moving away from the original content strategy that Netflix had, which was we're just going to get creatives and we're going to pay them what they want, and we're going to promote it like crazy and use all this interesting marketing. That seems to all be going by the wayside a little bit.
Yeah.
And so it's just something I kind of want to watch, because that's one of my biggest points of annoyance with tech companies is when they start this product and people really love it, a la Instagram. They're able to get people on the platform and using it and everybody's excited, and then they monetize it, and then they kind of creep towards profitability and they're like, wow, let's become even more profitable. And then they ruin the product trying to make even more money. And so it's just something I would like to keep an eye on. And the main takeaway that I had from reading the Financial Times article is they interviewed a Hollywood veteran who wanted to be anonymous, but they said the disdain for Netflix is beyond anything I've ever seen. They have eliminated the back-end financial profit participation of every artist in the world. That's another big issue, is essentially if you're a mid-budget creative who typically would have taken a small amount of money up front because you'd say, oh, it's okay, I'm going to get 0.5% of the revenue when it becomes profitable at the box office, because Netflix doesn't have a box office. That's not an option. And so now they've eliminated the back-end financial profit participation of every artist in the world, and they dominate and control everything, and no one's even close. He adds, the city is bleeding right now. Bleeding. So yeah, it's just something to keep an eye on. It's something I think as a Netflix investor, you can very easily keep an eye on by making sure that you're still watching maybe Netflix original content and you still feel pulled to go back to the streamer, even when there's a lot of competition. And so just something to think about.
I mean, I don't disagree, and I think it's an issue with combining art and business in a sense. But
yeah,
are Hollywood executives the most the people we're going to feel sympathy for right now?
No, but I do feel I do.
They have a long track history of being some of the worst people in the world. So
Yeah.
I'm not sure.
No, yeah. I don't feel bad for the executives. I feel bad for the writers who maybe have like one writing credit and they're trying to get a project off the ground and they're like, I need a $15 or $20 million budget, and now no streamer will go near that. It's basically $5 million or $65 million.
Yes, yeah.
And that $65 million pitch needs to come with your merch line, how it's going to be a roller coaster, how it's going to appeal to kids on Instagram. Like it has to be Stranger Things. That's the only way I think you're going to get budget now.
Yeah,
or you need to be WWE, because Netflix just signed a massive 10-year deal with WWE. So that's where we're going.
They're a lovely bunch of people who treat everyone the right way as well. So
who definitely give all the staff health insurance. Yeah.
Okay.
100%.
Right. All right, we're moving on to the EU now. This is making a lot of headlines. Basically, Mario Draghi, he was ex-EU head of, what was he?
European Central Bank.
Yes, there you go. I should know that. And he wrote a pretty scathing report on the state of EU's competitiveness in a global landscape, basically comparing it to the US and how far it's fallen behind since 2000. Now, Anne-Marie, this was a 400-page report. I only got about 3/4 of the way through for this podcast. How much?
Did you actually open it? I did when I watched the video.
I was researching. I was like, oh my God, I'm not. Show me the cliff notes right now. Yeah.
Yeah. No, I watched a video about it, and then I went and looked at all the charts inside it so I could kind of see what the main themes were. But yeah, you're right. Mario Draghi, he sat down to be like, why is Europe falling behind in terms of production?
Not falling behind. Has significantly fell behind. Yes. Yeah.
Yeah.
He had a great comparison. It was like since 2000, the 6 companies that have reached $1 trillion status have all come from the US, and nothing has been built in the EU that surpassed 100 billion or something like that. Was that the exact thing? Yeah.
Yeah, and it's a complete desert of unicorns. There's no unicorns in Europe. All the unicorns are coming from the US, and sometimes like they'll come out of markets that you're not expecting at all. But yeah, there's an innovation issue in Europe. And essentially, the factors that he's looking at in terms of production is standard of living, innovation, and R&D intensity are all highly correlated with production. So he kind of went and looked at these 4 factors, and he's like, what's going on in Europe that's preventing Europe from maintaining momentum with the United States? And kind of just to boil that down into a couple of real bare bones highlights, since 2009, Europe has slowed governmental spending on things like equipment, infrastructure, and innovation. And in that same period, there's a GDP growth gap that has opened between the United States and Europe. So this year, there was a 1.5% difference between how the EU grew and how the United States grew. And that is widening. And so that's obviously an issue because Europe is used to being the second best or largest economy in the world, and it's going to fall behind. And the most striking spending difference is going to come in venture capital, which is obviously targeted at very, very innovative tech, new age stuff. And the United States currently outspends Europe at a measure of 4-1 when it comes to venture capital.
That's not surprising. And that's also going to be a self-fulfilling prophecy as well, is because the venture capital is over there. Even if Europeans have this good idea, they're going to move to America to expand it.
Yeah, and it makes me think a lot of the time of like when new investors are becoming involved in the market, oftentimes we get questions of, oh, this company is European, this company is South American, they're Asian. Why are they trading on the New York Stock Exchange? And you have to say, well, there is just more capital floating around in America that is willing to be invested into companies. And so how does Europe address this issue? Because they want to be making new billion-dollar companies. It's good for employment. It's good for GDP. It's good for everything. The interesting point that he does say, though, is that it's actually there's not a knowledge gap. So we should say that it's kind of what you were saying. If a European person has a great idea for a company, they end up leaving and going to the United States.
And there shouldn't be, considering the state of the education systems in both regions. Do you know what I mean?
Exactly. So if you look at the university system, and the research field in Europe is incredibly strong. If you look at scientific publications, it is dominated by European teams. They are second only to the United States. The issue is just supercharging these research teams with money so they can become companies and they can become employers. Another big thing that is highlighted in the report is that the R&D and innovation spending that is happening in Europe is individually directed by each company. The EU rarely sits down and says, okay, here are our 5 big innovation and technology goals for the next 20 years, and we're going to be pouring $500 billion into this, or whatever insane large number that it might be in the United States. An example of this is Europe's largest investment continues to be the automotive industry, which it was the automotive industry 50 years ago. And that's not a great trend, because in the United States, the largest investments tend to sit in the pharmaceutical industry and the technological industries. And so that means that Europe's largest companies have pretty much been the same for the last 50 years. It's Volkswagen, it's BMW, it's that Dutch car company that I cannot remember the name of. But essentially, those companies that had dominated 50 years ago and were innovative technology 50 years ago are still the biggest providers of revenue, which is nuts. Like, that shouldn't be the case. And so what should we do about it? We need to spend a lot of money. And this is an insane amount of money that the EU basically needs to pool together and make strategic decisions centrally. It can't be allowing Germany and France and Italy and Ireland to making all these decisions on their own. They need to sit down and say, here's our goals. Here's how we're going to take advantage of AI or chips or whatever new technology ends up cropping up. And so the number that is quoted in this report is insane.
So what is
investment needs?
You know, go first.
Investment needs of 800 billion annually for the EU, which would correspond to between 4.4 and 4.7% of EU GDP at the current 2023 level. By comparison, investment under the Marshall Plan, which was the plan that the United States granted to Europe to help them rebuild after the Second World War, amounted to just 1 to 2% of Europe's GDP. So he basically said, I need you guys to go find 2.5 Marshall Plans and inject that directly into your economy to get the innovation going again, or you're just going to fall behind the United States.
Yeah, and it's almost beyond that in terms of cultural differences as well. Like, we talked about this.
Yep.
So we talk about Sweden a lot, either internally or on the podcast, and the investing culture that's there. Sweden is the only country, or the Nordics particularly, are the only country producing significant IPOs, and it's a deep-seated investing culture from when they're very young, which is very similar to the US. The UK has tried to bring this in with their ISAs and everything else, but that was only in the 2000s when they came about. And like that's where a lot of this comes from. If you create an investing culture, then you
Mhm.
get companies with enough liquidity to go public in that country instead of having to go public in wherever else, pretty much America. Like as in Spotify had to IPO in the US, CRISPR
Yeah.
had to IPO in the US. You know what I mean? Because they didn't have investors within their own regions that would be looking for it, I guess is the way you put it. So yeah, there's a whole lot of issues. The other one is, where the comparison is being made between the US, China, and the EU. The US and China are two of the top four producing oil countries in the world. The EU
Yeah.
is so far behind there and got even more
Mhm.
exposed with the Russian embargo on natural gas. So when we're talking about, say, the Paris Accords and the EU's commitment to climate change, that's probably coming from a place of, well, we put in these regulations because we're not regulating ourselves as much, in a sense.
Yeah.
You know what I mean? So yeah, there's an awful lot there. Like what's scary is the kind of conversation that's popping up around, oh well, do we have to put our climate change initiatives to the side to become more competitive? Which is
Yeah.
not very in I don't know. It's not what you want to hear in 2024. Like,
No, and I think it's probably also highlights again this idea of if Europe wants to say, okay, we're going to be the leader on environmental technology, we're going to be the leader in environmental infrastructure, for example, they should be supercharging 20 or 25 companies that could be creating innovations that will then be used in other countries. And, there is a gap in the market for them there because, the US and China compete in a number of industries that like Europe probably isn't going to get a substantial foothold in now at this point. Like the chips, for example, they're not going to get there,
no,
or they're maybe not going to get a search engine company at this point in the game, but they could sit down and say, okay, we're going to focus on environmental technology for the
yeah.
next 25 years, and here's $1 trillion.
Well,
Let's
like,
go.
do you know where they're never going to go? But they should is nuclear.
Yep.
Yeah, I know Germany just closed their last plant, so they're obviously going in the opposite direction. But from the US perspective and China perspective, they wouldn't want to stymie their own oil production, which is such a competitive
Mhm.
advantage for them by investing heavily in nuclear. But if the EU doesn't have that same foundation, why wouldn't they go after this? And it would also help with their own environmental initiatives. It's a clean energy. It's got its past history of issues, which you would hope modern technology would be able to kind of defend much better than it did in the 80s and all the rest. But yeah,
Mhm.
so I don't know. There's
Yeah.
also, and this is such a tangent, but the story of the Mexican fisherman. Have you heard that?
No.
And so you're talking about, it's funny you're talking about quality of life, um, which is so far from an economic data point, but is seen as
Mhm.
an economic data point just in terms of money. But
Yeah.
like people in America work so much, so hard. And it's the same
Mhm.
in Eastern societies as well, Korea, Japan, China. They
Yeah.
have incredibly difficult working conditions and expectations on them. And in Europe, that's not the case.
Yeah.
Germany, very much so. And like obviously certain pockets. I'm not saying this is a blanket statement, like as in I know there's bankers in London that work ridiculous hours as well. But in
Yeah.
general, there is a feeling of work to live instead of live to work, which
Yeah.
is 100% the attitude in a lot of other countries. And it puts into context that, yeah, maybe we don't want to be the leaders in this and that and everything else. Maybe we want to
Yeah.
enjoy our 7 months of unbelievable weather on the Mediterranean and drink wine and get fat and all the rest. So yeah.
Yeah, move a bit slower. That's interesting because there was a report that went out in the New York Times like 2 or 3 weeks ago, and it was showing the earning gap between Americans and Europeans, but it was using an average. And so it was like, oh, the average American makes $90,000 a year, the average European makes 35,000 or something like that. And everyone was like, wow, Europeans really don't make all that much money. But then a different economist took the data and was like, no, you should look at median earnings and see how median earnings are doing. And when you look at that, in the vast majority of European countries, for example, they took France and the United States. Yes, American people have the opportunity to make a lot more money in the US, but the median earning in France is outperforming the United States and has done for the last 30 to 40 years. So it is that idea of like, if you don't want to be an outperformer, if you would just like to have an average life where you get to have a family and own a house and you go to work from 9 to 5 and you get to come home and forget about it, that system is established in Europe to a much greater degree than it is in the United States or in Eastern Asia.
Big time. And
Yeah.
that's why, this happiness index and everything else.
Yeah.
Have you seen that? In all the top countries
Yeah.
are Scandinavian, because they are very much, they're not socialist, but they're bridging on socialism up there,
Mm-hmm.
and they pay unbelievable amount of taxes, but they
Yeah.
don't have to worry about healthcare, education, the
No.
support from the government, all the rest. So it's kind of almost, I completely agree with most of everything that's in Mario Draghi's report that I read page to page, obviously, and didn't just get a summary of, in the sense that Europe has completely fallen behind, and like the big companies it does produce have to go to the US.
Yeah.
But it's also an ideological battle of, well, kind of let them.
Yeah.
That's what the US is for. That's the ultra capitalist place. And like, if you are very rich or you're starting a business, that's an unbelievable place to do the business. But, would you want to live there if that's not your path? Probably
Yeah.
not, because it's very much a top heavy society. So I think it's an interesting debate. It goes well beyond this podcast.
Yeah.
But in terms of like quality of life and the difference in standards of living, it opens up a very interesting debate. And your talk on the difference between average and like, average is a bad way of looking at America as a whole, because it's so diverse, and there's like the big cities,
Mm.
and then there's incredibly rural parts and all the rest. So yeah, it is. It's a tough
Yeah.
comparison. It's apples and oranges, really.
Yeah. It also kind of reminds me of the like Boeing versus Airbus fight that went on for decades and decades, where Airbus used to get criticized by people in private equity and by investors because it's builds in France, where unions are incredibly strong. Their personnel cost was always very high, particularly even in comparison to Boeing during the glory years, like before Boeing got private equity involved and laid off all their senior engineers and had all the planes falling out of the sky. But that was always an issue for Airbus. They were like, the cost of doing this work in France is too high. You should move somewhere else. You should not allow this union to be so powerful. You should not be giving your staff 40 days of vacation a year or whatever other benefits they were getting. But then we sit here and we think about, well, when it comes to airplanes, I would like the airplane to be of the highest quality possible, because I'll be on it and I'll be in the sky. And, there's no alternative once you get up there.
Absolutely. And also, if you were an aerospace engineer, would you prefer to work at Boeing or Airbus?
Airbus.
Yeah,
Airbus.
completely.
You want to be at Airbus.
There's only one answer to that.
100%.
Yeah.
Yeah. And now we think about, well, Boeing was able to produce planes for cheaper. It was always the favorite in the aerospace market and blah, blah, blah. And now Boeing has this horrible reputation, both when it comes to rockets and planes. And over the last 2 decades, we're seeing Airbus creep up and creep up and creep up and sign more and more contracts with major carriers. And so that is kind of how sometimes I feel about it as well, where I'm like, yeah, Europe isn't moving as fast. It's not as innovative. It's, it doesn't have all this much money. But sometimes when it comes to quality, Europe is superior. You think about all of the big companies that come out of France, and their big thing is always focusing on quality.
Luxury,
let's hand
the luxury brands,
let's hand make something. Let's spend 7 years making something, that kind of thing. So yeah, it's not innovative, but it is good in another way, I suppose.
I get you. Yeah, it's not. They don't have the move fast and break things attitude that America has in abundance. Yeah.
No, it's move slowly and learn things and maintain your staff for 45 years, so then they become world-renowned experts, kind of thing.
Yeah. Okay. Yeah. Well, I think we could keep going, but we need to cut this off eventually. Yeah. But it's an interesting chat, and I don't know. There is no right answer to it. No. If you're going to ask where the next batch of trillion-dollar companies are going to come from, it's 100% the US over Europe.
Oh yeah.
Yeah. Like there's no question of that. But is Mario Draghi kind of? I guess it especially from an economics point of view, if you're one of the top economic advisors to this region and seeing it falling behind and getting an aging population, you're going to set the alarm bells. But maybe people are okay with them alarm bells. Yeah. Okay, we'll finish it there. Anne-Marie, thank you very much for joining me, and thank you everyone for listening in on our ramblings. We kind of went off page there for the last 20 minutes. But yeah, so just a reminder, if you missed out last week or you're still interested, we have the Nexus offer running again this week. So just email in at pod@mywallstreet.com. The first 5 emails will get a chance to get a very significant discount. That's pod@mywallstreet.com, pod@mywallstreet.com. Okay, thanks for joining us, and we will talk to you next week.